credit unions have implemented and done all this work to get their digital account opening in place. They've done so much work. They've spent so many resources, so much money. And after all of that, we're, at a 15% application submission rate. Mind you, one of the other things that I would like to break down later, it's not just the completion rate. The next phase of that funnel is the approval rate for accounts, and that is abysmal as well. I have credit unions right now that are declining 70% of the applications that are being submitted. So after someone jumped through hoops, did everything they needed to, found their ID, found their mother's maiden name, found their mother's, father's, best friend, dog, whatever, they're still getting denied for membership.
Welcome to Banking Transformed, the top podcast in retail banking. I'm your host, Jim Marous. Organizations are spending massive amounts of money in digital transformation, and most banks and credit unions are also still struggling to deliver a seamless, intuitive, and simple account opening experience. In fact, most financial institutions could double their digital account opening just by following a few simple strategies. In other words, your customer onboarding process is broken. Today, on the Banking Transform podcast, I'm joined for the third time by Frida Leibowitz, the co-founder and CEO of Debi. It's a fintech platform that not only helps institutions attract younger members, but also rewards positive financial behavior that boosts engagement and loyalty. We'll not only discuss Debi's rapid growth, but more importantly, the findings of the recently released study on digital account opening, where they review all the players in the business, tell you what works, what doesn't work, what's good from a customer experience perspective, and what's good from a financial institution perspective. If your organization is looking to update and improve your digital account opening onboarding experience, this is an episode you can't afford to miss. According to a recent study, banks and credit unions can increase application completion rates from a dismal 15% to over 50% or more by focusing on speed, simplicity, trust, and intelligent integrations. The key is to actually treat account opening as the beginning of a relationship, not the end, using behavioral incentives and personalization to build long-term loyalty. So welcome back to the show, Frida. Despite being a relative newcomer still to the banking space, this is the third show we have done together, which says something about how much I love your Debi platform, as well as really enjoy time with you. So for those who may not know who you are or have not heard of the Debi platform, can you provide a little bit of a background?
Sure. And thank you so much for having me. This is so fun. So anytime you hit me up, I'm ready to do another podcast. A little bit of background about myself. I'm Frida, co-founder and CEO at Debi. My background is actually, even though maybe not many years, but I did spend a couple years at Marcus by Goldman Sachs in its early days. Went through that entire train ride and then train wreck, but learned a lot, and then started Debi really with the mission of helping consumers make better decisions with their money, specifically focusing on what we call the 99% low middle income consumers. What Debi really does is we are a rewards program for financial wellness. Think of us like credit card points, but reversed. Instead of getting points when you spend money, you get points when you save, pay down debt, reduce spend in certain categories, and behave in any way that is, that helps you mitigate your risk over time and perform better. We partner with financial institutions, primarily credit unions to date, to really help drive new membership and engage that membership in a way that is really focused on long-term health for the member and really high ROI for the financial institution as well.
It's interesting because in the discussion we've had with you in two previous podcasts, it becomes more and more apparent that this is a tool that's needed, that really will get a high response rate, because anybody who has credit that's a little out of control is looking for that breakthrough, that reason to change their behavior, and rewards can do that. And what's interesting is it's actually, as you said, it's a gateway to new relationships for financial institutions. How has the response been to your very unique platform? Can you share a success story with me?
Absolutely. So I think on the consumer side, we've started to hit that virality. Today, a lot of our growth is coming from referrals, for example, and that really tells you, if someone loves your program, they're inviting their friend, they're inviting their family member. That's a very positive sign. I think also, we get love letters from users on a daily basis at this point. People really tell us that even though these are seemingly small little nudges on the as they're moving on the right path, it's changed some of their lives. We get that feedback from them all the time. They will use those words. This changed my life. This helped me think of myself, celebrate my wins, and think of myself as someone who can handle money, as opposed to only hit me with fees and punish me when I'm not good with money. So I think from the consumer side, that's been great. From the financial institution side of credit unions specifically, we've also had an incredible growth path and some very, very positive feedback. We grew last year from 2 partner credit unions to now having 11 on the platform. So we more than 5x'd in a year, and I think that has also been very telling of the credit union industry and how there is willingness. There's a lot of willingness to innovate, to be the first to do something, especially when it comes to when you think about consumer wellness. I think credit unions are the first to kind of get on board. And so, yeah, we're feeling very grateful to be here and be working on something that clearly matters to people.
So it's interesting. As I mentioned in the introduction, you just did a recent study of digital account opening processes and experiences, as well as the people that are actually providing the gateway to better digital account opening. And I got the impression when I read the report that the reason why you did this was not just because you wanted to get a nice report out to the marketplace that needed it, but because you're really an onboarding process. You're a way for organizations to get leads of people that are ready to open a new account to get your service. However, I think you found out, as I am well aware, is that for most organizations, the digital account opening process is dramatically broken from beginning to end. And what ended up happening, I think from your study, was that you were giving leads to financial institutions, but so few of them were being closed, not because people didn't want your service, not because they weren't willing to open an account digitally, but because the service was broken from internally to the financial institution. What really jumped out, and I mentioned it in the intro, is that a 15% average completion rate for digital account opening, which is actually something very similar to what we've seen in the past, that the process in the digital world, as opposed to the in-person world, is really fragmented. Why is that number still so low in 2025 when everybody's talking about improving the digital experience?
Yeah, absolutely. You're right on point. And I'll even add to that. That number is still low after credit unions have implemented and done all this work to get their digital account opening in place. They've done so much work. They've spent so many resources, so much money. And after all of that, we're, at a 15% application submission rate. Mind you, one of the other things that I would like to break down later, it's not just the completion rate. The next phase of that funnel is the approval rate for accounts. And that is abysmal as well. I have credit unions right now that are declining 70% of the applications that are being submitted. So after someone jumped through hoops, did everything they needed to, found their ID, found their mother's maiden name, found their mother's, father's, best friend's, dog's, whatever, they're still getting denied for membership. And it is absolutely wild. We can break all of that down, really mostly based on qualifile, actually. So we break it down to understand where this is coming from. On the fraud side, definitely, as always, when you start doing digital marketing, you're going to hit some fraud problems. However, the policies that these credit unions have implemented, even with their fancy digital account opening, are still so outdated and they're so completely tone deaf to what's going on with millennials and the young generation and how they behave digitally. And I'll give you some examples. Me, got denied for one of our credit unions, and I was flagged for fraud. I got denied for membership. When I called and tried to understand, of course, I used my special connections. I called up our partners. I'm like, hey guys, I applied. I didn't get accepted. The reason for that was that my IP address was in one place. My license, I think I was maybe traveling at that point for a conference. My license was a New York license, and my address was a Florida address. Now, this is very old school thinking. If you're a millennial today, especially if you're Gen Z, it is very likely that you are traveling, that your license is still based on who knows how many addresses ago, and that you now live somewhere else. We are not going and updating, we're not living in the same house for 40 years. That's not what happens. We're moving every year or two, we're moving somewhere else. Our license might still be, so many of our users, the license is still based on their parents' address. They still have, some of their mail going there, some of their, any official documentation. So that to me is a very tone deaf way of like, kind of like not really understanding where the times are at. That's one example. The other one is they look, even the ones that are a little fancier, they're looking at digital footprint. They have this threshold. We saw one user got denied because they had excessive accounts opened digitally in the last 6 months. Now, again, you're looking at a demographic that's literally coming through fintech. They are trying out so many different apps. They're opening up different accounts. That threshold, and then I think this credit union was very open and amenable to saying, hey, actually, maybe we need to loosen this threshold for a digital channel because these are consumers who are digital. Their lives are digital. They're opening up, this is not 1999. It's very easy to open up an account in new places. It's very easy to try out different apps. And so I think on the fraud side, there are so many credit unions will just automatically dismiss it. They're like, oh, it's fraud. It's fraud. So no. I'm like, no. Let's look at this applicant. Let's see why you tag them as fraud. And those are the kinds of things that we find. And I think really we need to raise a lot of awareness about. I think
go ahead. Yeah. Go ahead.
No, I mean, ask your question because I'm going to dive into the credit bit in a second too.
Yeah, go ahead. That's what I was going to ask you about.
Okay, we'll dive into it. Great. So on the credit side, let's break that one down. We looked at some of these accounts. And what's interesting to me, and this is just baffling, I have LIDS-based or LIDS-certified credit unions who declined a teacher, okay, who is at their local, one of the local counties. This woman was just in debt, clearly had not a great history, and couldn't get access to a credit union membership. If you are a credit union that says everywhere, preaches everywhere, that you are focused on this demographic, the very least you have to do is not auto decline this person, this individual who is really, right, like this is again a teacher who's working in the public school system, who's working really hard, who's making way too low of a salary, and is struggling, and yes, has had some black spots on her in her credit history and her ability to be responsible with her bank accounts. But if you are saying everywhere that you are going to be that institution for these kinds of consumers, then you need to put your money where your mouth is.
Yeah, it is amazing. We went through a situation, my wife and I, we lived in California for 3 years during the mortgage crash, not the mortgage, not the appreciation of properties, but during the mortgage crash. And it was interesting because when we left, some state agency thought we made money on our house over the 3-year period that nobody made money on their house, and therefore put a lien on the account, and then we had to work through it. But during that process, we were turned down by a lot of companies for credit, and none of it was true. And once we worked through with them, that was another thing. What was interesting is I almost could understand it when I was applying for credit. A consumer has a very hard time understanding why you are turning them down for a deposit account because of a somewhat adverse credit relationship. And as you said, some of the institutions are able to approve, after they've looked at this, more than 50% of those people that they turn down just off the bat because they use some electronic way to determine credit adjudication or fraud risks, anything of that nature. Not that risk and fraud are not important. The challenge is, are you shooting yourself in the foot with the consumers that will actually give you loyalty for a very long time for looking out for them? It's interesting. Your report talked about an outline for a 50% completion rate possibility. What were the biggest friction points you saw that were killing conversions today? And just as importantly, which one do you think are the easiest ones to fix?
Yeah, absolutely. And it's actually not even just things that at this point, it's very data driven because I have today a credit union on my platform whose completion rate is 5%. I'm not going to mention the name of their account opening provider. I let the crowd guess. There's really only a few names that will be a possibility for this. And then I've got a credit union whose completion rate is over 60%.
Yeah.
So they're beating even our like the benchmark we're setting, right? And and by the way, that credit union who has a 60%, we have another credit union who's using the same digital account opening provider who's like less than 20%.
Yep.
And that's because digital account opening providers, they can only give you the tools. But if you are going to force your old policy into these tools and try to just do it digitally, sure, maybe you'll do better than paper applications, but you're still going to be, you're really not going to make it all the way there, right? If you're going to still think that people need to provide every single bit of information about themselves and their entire history and their entire family history, they're not going to do all of that for a checking account when they can go to Chime or Varo or SoFi and apply within 3 minutes with much less information. It's just not what's going to happen. Like that's who you're competing against, right? And so I think let's break down the actual differences of what we saw between the applications. I would say the absolute number one drop-off point is ID upload.
Yep.
And I know this is such a sensitive one. And every time
It's
I
a
bring
big
it
one
up,
for me,
I
I can
already
tell
see the
you,
credit
yeah.
union just getting hibby-jibbies. They can't even handle they're like, no way, no way, no way. But this credit union, they knew they had aggressive goals and they removed the ID upload. They are using very sophisticated integrations and digital ways to verify consumers, and they only do an additional ID upload requirement if there are certain risk triggers, right? So you basically start creating a smarter path. At this point, there are plenty of ways to do digital identity verification.
Yep.
Without requiring an ID upload. So I would say that's the number one current, like what we see is just completely kills the process. So I think right there is like 60% drop off.
And it really, what's interesting is organizations will pay for a partner to help them with their new account opening process. Again, looking for that 3 to 5 minute account opening process. They think they've gone through every single dynamic of it. And then the organization comes in, is ready to put it in place, and they go, well, I still need the regular ID. And you go, why, as you said, two organizations, the exact same platform, one's successful, one's much, much, much less successful. And that's because, for lack of a better term, the bankers got in the way. They said, well, I like everything you're doing, but we won't let go of this to get there. That shows not only a poor sales process because you're selling to somebody who's not really ready to buy what you offer, but it really shows a bad buying process where you're not willing to do what the organization says is needed to make it work. Everybody who listens to the podcast knows there's very few podcasts I go through without complaining about the new account opening and the fact that the tools are all there. The problem is as you said, I can't change management if management's going to buy the technology and not use it the way it was built. It's not going to work. So what's the one you'd fix?
What is the one I'd fix?
First, yeah.
I think the ID definitely. If a credit union really wants to, like, it really depends how comfortable. And also, I think a lot of the time, the folks that we're working with, specifically the individuals we're working with, are so motivated to bring about change, and then they keep hitting roadblocks inside of their own organizations. And so it makes it very tough for them. But one of the things that we are trying to help them do and help them pitch is how to jump into the deep end with floaties. So what do I mean by that? You got to figure out how you're going to take risk, but manage it. That's what I call risk management. It's not that you're just going to accept it. You're not going to just say, okay, sure, I'm just going to, do completely digital identity verification without requiring an ID upload, which we could even debate if that's even less, if it's even more risky to do digital. I don't even know. But let's say you feel that it is. What this specific credit union that had the 60% completion rate did is that they push any consumer that we send that is above, a certain threshold of potential risk for them. What they just do is they push them to a very simple checking account that has no overdraft capabilities, as very basic, and then they wait for them to prove themselves for a little bit before they can then qualify for a better checking account. That's a great path. You're letting someone in the door. You're giving them the most basic service, a checking account. The risk is minimal. If they do see, they've got checks after the fact, after the account's been open, they are checking, they're making sure. If they see suspicious activity on that account, they shut it down. But the upside that they get, the amount of people who are good actors, right, who are just
Yep.
not going to
Yep.
put up with all of these crazy hoops you're making them jump through, they get in. And then the risk the worst case scenario, you open up a few accounts that you then have to close within 3 months. But you still net got what brought way more members into the door.
Well, and the losses, even the losses that happen, are not that great. This whole thing we talked about before we got on the air, the whole issue of complete risk avoidance as opposed to managing risk. And it's interesting. Your study was very unique. At least I haven't seen one of its kind where you actually looked at all the organizations that help in the new account opening platform, and you tested them all. Not just testing with questions and answers to the organization that used them, but you actually opened the accounts and said, which ones of these felt right from a customer's perspective and from an organizational perspective. And you went through all the big ones. Yeah, we're not going to go through the names here, but bottom line is you opened accounts with all these platforms and you found some experiences that were really good and you rated them based on why they were good and some that were not so good. So what were some of the good experiences and what was one of the bad ones that really stood out?
Yeah, absolutely. And I do want to
And
put a
why?
pin quickly in the cost. I want to
Yeah.
put a pin in the cost point that you made because I want to get back to that because I want to
Yep.
talk about the numbers and the math and let's really figure out how to think about the cost benefit analysis for this. But if we go back to the report that we had put out about the different account opening providers, I think we try to be very fair, and I do think that especially when it comes to the top 4 or 5 that we looked at, and we're partnered with a bunch of them. Also, just disclosure, we have integration partnerships with some of them that are great that are helping us kind of make change together. And I think what really stood out are a couple things. One is, of course, the user experience, right? Each one of them, some of them do a better job, some of them do, a good job, but maybe not as good as some of the other ones. I do think that all of them, though, have a pretty strong baseline. At this point, the top couple of digital providers are the ones that are growing the fastest right now. You can kind of see they've got a really nice like digital experience, and I think that piece is great. I think the second piece, and this is where there starts to be a lot more, well, it's two things tied together, and that's where the differentiation starts to really happen, is the lift that it takes to implement, right? So the implementation effort. And then usually that is paired with the customization options and how robust and how many different, does it also offer business banking and all kinds of other bells and whistles and whatnot, right? That's where that can get interesting. And this is where there isn't necessarily like we don't have one partner. They're like, this one is the best. You should go with this one. And we never come with that approach to conversations. It's usually we just provide, here's who we think this is best for. And based on the team that you currently have, the technical resources that you have, the needs you're going to have for your organization in the short term and the long term, these are the things you might want to consider. And I think that also the digital account opening providers definitely have each taken a little bit of a niche, right? They've kind of figured out what they specialized in. And because there are so many options in the market, this is great for credit unions. There's a lot of healthy competition happening right now,
Oh, yeah.
which means that each one of those companies is working super hard to get very good at, one or two things that they do best. And so I think at this point, for most credit unions, there's really, they're really, when they're making their decision, it comes down to just one or two that really fit their needs and can be perfect for what they need.
So that said, what? Let's put you in charge of a medium-sized credit union or community bank. What would you be looking for now that you've dug into these from both the customer experience perspective as well as knowing the financial institution and your partnership experience? What would you be looking for a digital account opening partner?
Those are great questions. I think for me, I would definitely be looking at one, the user experience. I think that at the end of the day, like what your member is going to go through is super important. Like I said, even when you filter off user experience, you're still going to get like at least 4 or 5 really great options that all
Yep.
have a great user experience. I think the second one, and this one, obviously I'm a little biased being a fintech, I would look at which of these providers is really going to become a platform that I can leverage to then do other partnerships.
Oh
How
yeah.
flexible is this going to be? And how is it going to help me grow? Because like I said, in my example of the house, right? If the credit union is the house, the digital account opening is the plumbing. So the plumbing is great. You want to get your plumbing? Perfect. So what your guests arrive, their experience is great. But you want to make sure that that plumbing can connect into, right? Like that everything can kind of work together. And so in the future, when you want to plug things in and you want to actually bring the people, right, get the people in, you have a way to do that. And with that, I think the last piece, which is of course always important, is pricing structure. Each one of these digital account opening providers has a different cost structure, and they're really tailored for different things. Sometimes different size credit unions. Some of them are a better fit if you're growing super aggressively, right? Then you might want to go for more of a flat fee structure. You don't want to maybe increase your costs exponentially as you're growing. Some of them do have the per application type of costs, and that might make sense for, other credit unions who are maybe not growing as fast, but are looking for something that they can kind of manage the budget based on their growth goals. So I think between those three things, that's really what I would use to make my decision.
Yeah, and you talked about the fact that most bankers see the account opening process as a finish line to their marketing process. Basically, geez, we finally got where we wanted. We had the account opening, but you really view the digital account opening as the beginning point. Is that what you mean when you talked about the ability to integrate with other platforms, with other solutions in the marketplace, or is it beyond that?
And that's exactly what I mean, because like exactly what you said, right? This is just the starting point. You
Yeah.
just got your plumbing right. That doesn't mean just because you did that doesn't mean that people are going to come now, right? Like you need to then get them in, and you need a platform. And not just that, I think some of these platforms allow you to, after the people are already in, to continue to engage them, right? To know how to target them for additional products, or to provide a clear platform where they can then come back for additional products. And so I think those things are really critical. You want to know how you're going to be able to plug in both a mechanism for acquisition to start happening, to actually bring people in, and then also once they're in, what other features are you getting that are helping you maintain the relationships, build the relationships, etc.
It's interesting because when we really look at, in many cases, looking at the Gen Z and millennial consumer, these segments expect different things from their financial partners. A lot of times it's education, financial wellness, empathy more than anything else, simplicity, speed. Sometimes some of the Gen Z and millennials also need that in-person relationship. How are you seeing organizations? Because you're really appealing to those segments as much as any. Sure, there's outliers. There's probably people like me that probably could use your service, but what do these segments expect, and how are financial institutions right now falling short in meeting the overarching needs of the new to banking customer?
Oh, I'm going to say something very controversial. And this has been an interesting thing that I've been exploring lately. I think, let's zoom in, not just the millennial and Gen Z, but let's talk about the millennial and Gen Z who are really struggling financially right now. And the very disproportionate amount of our generation is struggling right now.
Yep.
So, and I think when you're at that struggle, if you look at like the Maslow hierarchy of needs or whatever, right? The finding meaning and selling me all these bells and whistles, it's like telling the people to eat cake, we're going to care. We have a mission. We care about you, all these things. What we have found is when a consumer is struggling and they want to get on this rewards program so they can like get their rewards, learn, get better, even when we match them with a credit union, we actually do very little explanation in the beginning about what the first thing they want is to just get access to the thing that they need. They don't want to hear about how amazing and how much the credit union cares about them. Frankly, they don't give a flying rat about what your credit union's mission is and how you serve people in your community. They will go, and that's also why, I looked at it. 50% of our user base is going to payday lenders and payday loan alternatives.
Yeah.
Do you think they care that these payday loan that they are super predatory? They don't care. They go there because, and by the way, of those, 89% are repeated customers. So this is not a one-time, oh, I slipped. I'm regularly going back to the same horrible financial service because it is providing me something that I desperately need.
Yep.
And if getting a payday loan is so easy, but going to a credit union and trying to open up a checking account is so difficult, right? Like, just put those two together. And so I think what credit unions need to think about is, first, just give them a way to just, right, like, first get in before you start telling them about all this financial wellness. And then afterwards, I think what we have found is once they're in and once they're kind of getting that some relief, some help, then they're very open and willing to hear about the mission. And that's what makes them stay. That's what makes them kind of build the loyalty. That's what makes the brand perception, right? They now have a better brand perception, unlike those payday lenders, right? We're very, like those, obviously the consumers hate those guys. So I think it's really, you have to think about the hierarchy of needs and first serve the very acute need that this consumer has right now. And then you can drive them towards purpose, towards loyalty, towards understanding why your mission is really important to them and financial wellness tools, et cetera, et cetera.
So it's interesting. Your passion, the passion of your co-founder, the direction of your organization, what you're trying to achieve with Debbie is very aspirational. Is obviously I'm hooked because we've had you on as much as anybody we've had on the show. When you're talking to a financial institution, everything seems to be just, boy, it hits the spot on what I want to do, who I want to hit. What gets in the way of them saying yes from your perspective? What is the thing is there any one or two things that you realize, geez, some institutions aren't ready or whatever it may be? What is the reason why somebody may say no?
This is a good question. Are you referring to them saying no to Debbie or saying no to change on some of their processes?
It may be the same. I was going to actually separate a digital new account opening platform and Debbie, but probably because I can't think of any reason to say no to a digital account opening platform, it may be the same. But what do you see as geez, this is something we got to get out of the way early in a conversation because it's going to get in the way if we don't deal with it immediately?
Yeah, absolutely. Great question. I think actually we're going to tie this very nicely into the cost thing. And we released a different report on called "What is your MAC? What is your member acquisition cost?"
Oh, yeah.
And we did another study that found that more than half or close to half of credit union executives don't know what their acquisition cost is per member. And I cannot tell you how many times we've been in conversations where we ask them, what's your budget? How much are you willing to spend to acquire members and to engage them? And they have completely unrealistic expectations. And actually, this is a good time to announce a very cool new feature that we're building on our website. It's actually already built, but we're adding more credit unions to it, where we will calculate your back for you. Because all credit union financials are public, we built a scraping algorithm that will literally scrape your financials, and it will tell you how much you are actually paying for new members and how much you're paying for deposits that you have. And I think that's usually one of the things that we like to get out of the way first, because credit unions will come with very aggressive target growth goals for their number of members that they're going to get. And they are absolutely sure that they're spending so little money because they're stuck back in 20 years ago land when people will just walk around the block and join your credit union. Yep. That's just not realistic anymore. When we did the math, the average credit union is spending $489 to acquire a new member. And some of them are spending more than $1,000 to get a new member.
Definitely. Because they'll either say, here's how many accounts we opened against what we paid in, direct costs without taking into the indirect costs. But even more importantly, not looking at how many of those customers stayed, how many of them, we used to have a figure at a bank I used to work at where there was a difference between one bank and the other. That was because one bank got rid of customers very quickly if they weren't active. The other one held them on longer. Well, those metrics are come out to be different, even though the reality is very similar. And you're right. Organizations way underestimate what they pay for a brand new customer and for one that you actually keep. They talk about numbers that come in the door. And that's also where the metrics get really messed up between digital account opening and in-person account opening, because they put different metrics against them, even though some of those costs are overarching, no matter if you had the branch or didn't. So it's very interesting dynamic.
Yeah, for sure. So I think and tying it back to what we were talking about, how to improve the funnel and the cost benefit analysis. If you are a credit union paying $489 for a new member, and that is a direct cause of you only accepting, only getting X amount of applications in the door, and getting, right, if you could only just double the submission rate,
Yep.
Theoretically, you reduce your cost by half,
Right.
right? And how much money is that saved, right?
Yeah.
A lot of money, $200 per account you're saving on acquiring them. What would have to happen to that checking account if it has no overdraft, or even if it does, but in a very small amount, right? Like, think about the cost benefit. You're probably going to be saving a lot more money on your acquisition costs, regardless of whether you have a little bit higher fraud losses or whatever you want to call it. And even then, like I said, you can have your floaties on, make sure that you're not giving everybody, overdraft accounts and whatnot.
Yeah, it's crazy because I keep on coming back to you looked at your ratios of people that get actually through the whole system versus those that don't. And you tell them, I can very easily, just if you can change your perspective a little bit, I can double the number of accounts that get through, which means you're doubling your new account openings at a time when that's one thing you were putting a whole priority on. I can do it without changing your marketing, because what's happening is all these people come to the door, and then you make them go around to the back, jump the fence, get a new key lock, get a new key code. Then you get in and you go, well, there's 3 more doors you have to get through to get to the party. And even then, we're not going to give you any food. We're not going to give you all the benefits. And you just go, holy crap. And these people are wanting to do business with you. These are not, as you've referenced, these are people that came to you first, and you've made it so difficult. And what happens sometimes is they benefit because someone's gone to 3 other institutions that treat them the same way first, and you just happen to be the point of breaking, where they go, it looks like everybody treats me like this. I'm going to open an account. So you may not even be getting people that actually want to do business with you. They've just gotten worn out through other organizations. So let's get back to Debbie for a second. What is on the horizon? Because you've done very well. What do you see on the horizon? What do you see as being the growth metric, and what's going to be changed in the next 12 months?
Yeah, absolutely. Well, we've got a lot of really fun things on our roadmap, but 2 things that are particularly relevant here. First, this summer, we are launching a very cool AI-driven feature that is basically our partner matching system. We overhauled this now that we have a bunch of credit unions on board and some larger financial institutions as well. We basically are building a smarter algorithm to match folks to the correct financial institution that's going to serve them best. And what that algorithm could take into account is not just your geography, your credit risk level, things like that. It can also take into account your age, whether or not you have kids, your relationship, that's right, and really match you with a credit union can serve you well. We actually have a really nice UI where we show the user almost like a dating app kind of match, where we matched you with this is a perfect financial institution, and they will get a personalized screen that will show them the services and products that this financial institution is offering that are particularly relevant to them. So if they've got young kids and they're worried about kids' checking accounts, it will show them that. If they really want a local, we will literally show them, you have a branch X miles from your house. Things that are super personalized to them, and we have a compatibility score. So we will show them how compatible they are. And of course, we don't show them anything below a certain threshold of a compatibility score. I think this is, from a user perspective, I think it's going to make a huge difference. It's going to make people kind of feel like there's a lot of reason behind why we are bringing them to credit unions, and it brings us back to our mission and my true belief that credit unions are really best positioned
Yep.
to serve these consumers in a way that is really unparalleled by any other type of financial institution. And I think on the back end of that, what else is interesting is that we're feeding in data about what happens after account opening. And that data about who becomes active with the credit union, who's really engaging with the products, and it starts optimizing the entire algorithm. So it looks at you and it says, Jim has this kind of profile. And in the past, people who've had the same profile as Jim performed really well at credit union X. And therefore, we're going to match you into this credit union. And so I think that's that like continuous learning model that keeps basically understanding which credit union can best serve which consumer, I think is going to be massive. It's going to be a really, really big value that we can help add to this industry. And on the second piece, and I think this is something that, to be frank, like we're very aware of and working to solve, and that is what happens after account opening, which even after we match someone and we get them through the rewards and all these things, we've definitely seen that it is very important to get the ROI, to get the usage, to get people to use the account for more than just getting their Debbie rewards. And so we are launching the like our new reward system also later this summer, and that's really going to be, just like credit card points where you can earn multipliers on specific transactions. Users will be able to earn multipliers on transactions with the partner credit unions, partner financial institutions. So I think that will also be huge because it will help create a very direct incentive to transact and engage more with these credit unions beyond all the effort that they're putting in to getting these members.
It's funny because you talk about the engagement, and that's the holy grail. It goes beyond experience, and you already know so much about the customers you're referring to the credit union that there's a whole lot of engagement capability there going forward. Frida, it is always fun to talk to you. It's fun to meet in person, fun to meet you over the video here when we do a podcast. I really appreciate your time. How do people get either one of your studies referenced? Not only digital account opening one, but the one about the amount it costs you to open an account. How do they get those reports?
So you could go to our website, joindebbie.com. We have a partners page and all of our case studies, reports, everything is there. You can also access our new tool, Measure Your Mac. And you can, right now it's available for, I think, the top 100 credit unions, but we are now expanding that to the top 500 to 1,000. So if you're in that list, or if you're interested in looking at anybody up, you can literally type in any credit union in that list and find out exactly how much they're paying for acquiring new members.
It's kind of interesting too. Anybody who's thinking about fixing their new account opening process, get the report, because you really get quite deep into what the experience is with each of the platforms. As you mentioned, some of them you have relationships with, some you don't. You did a great job. It was almost like a food rating, a restaurant rating score, because it not only said what are the goods and the bads, but oh, by the way, you have this cost function that says is it 1, 2, 3, or 4 dollar signs as far as what it's going to cost you. And I think it's very helpful. It's a good starting point for institutions. Again, I think you have a great platform, and you're reaching an audience that really needs help in managing their finances. And these people are begging for assistance. And hopefully we can open the door to make it so people don't have to keep on jumping fences and going around the doors.